Welcome back to the channel. If you're thinking about jumping into the stock market, I need you to pause right now and listen to what I'm about to share. The difference between investors who build real wealth and those who lose money comes down to avoiding 5 critical mistakes that most people make before they ever buy a single share. If you're new here, hit subscribe so you don't miss these essential lessons that could save you thousands of dollars. Let's be honest, the stock market can seem intimidating. You see all these confident people talking about their gains, and you feel like you're missing out. But here's the truth that nobody wants to tell you. Most beginner investors lose money, not because the stock market is rigged, but because they make the same predictable mistakes over and over again. Today we're going to walk through all 5 of them, and by the time this video ends, you'll know exactly what to avoid. The first mistake is jumping in without understanding what you're actually buying. This sounds basic, but you'd be shocked how many people buy stocks they can't explain. They hear a friend mention a company, or they see something trending on social media, and suddenly they own shares without understanding the business fundamentals. When you buy a stock, you're buying a piece of ownership in a real company. That company makes products or provides services. It has revenue, expenses, and profits or losses. If you can't explain what the company does, what its competitive advantage is, and why it makes money, you should not own it. Investors who do this right spend time reading earnings reports, understanding the business model, and comparing the company to its competitors. They know that investing is not like gambling, even though it can feel that way when you're starting out. The difference is knowledge. Knowledge is the barrier between making money and losing it. When you understand what you're buying, you're making a conscious decision based on facts, not emotions. And that's where real investing begins. The investors who build wealth are the ones who can sit through the uncomfortable periods without making reactive decisions. They have a plan, they stick to it, and they don't let fear run the show. Emotions are the enemy of wealth building. Control your emotions, and you've already won half the battle. The third mistake is not having a clear investment strategy before you start. This is where a lot of people go wrong. They open a brokerage account, they have some money to invest, and they just start buying things without any real plan. Should you be buying growth stocks? Should you be focusing on dividend-paying companies? Are you investing for retirement 30 years from now, or do you need this money in 5 years? Your strategy should be completely different depending on your timeline and your goals. Before you buy anything, you need to ask yourself some hard questions. What is your investment goal? When do you need this money? How much risk can you actually tolerate? Not how much risk do you think you can tolerate, but how much can you actually handle without losing sleep at night? Once you answer these questions, you can build a strategy. Some people should be in aggressive growth stocks. Others should be in dividend stocks or index funds. There's no one right answer, but there definitely is a right answer for you. And you won't find it by guessing, you'll find it by planning. The fourth mistake is trying to time the market. This is the fantasy that thousands of investors pursue every single day. They think they can figure out the exact moment to buy low and sell high. They watch charts, they read tea leaves, they listen to so-called market experts, and they try to predict where the market is going. Here's the uncomfortable truth. Nobody can consistently time the market. Not the experts, not the hedge funds, not anyone. The data is overwhelming on this point. Most professional investors with billions of dollars and teams of PhDs fail to beat the market consistently. What makes you think you can? The real wealth in the stock market is built by time in the market, not timing the market. The people who invested during the financial crisis in 2008 looked insane for about 18 months. Then they looked like geniuses. The people who tried to time that bottom missed it by a mile and never recovered. If you have a good strategy and you're invested for the long term, the specific entry price matters far less than you think. What matters is that you're invested, you're staying invested, and you're giving your money time to compound. That's it. That's the secret. The fifth and final mistake is underestimating the power of fees and costs. This one flies under the radar for most people, but it's absolutely critical. Let's say you're investing for 30 years. You find a stock fund that charges 2% in annual fees. Compared to a low-cost index fund that charges 0.03%, that 1.97% difference might not sound like much. But over 30 years, with compounding, that difference amounts to more than 40% of your total returns. 40%, just gone to fees. This is why you need to pay attention to expense ratios, trading commissions, and advisory fees. Every dollar you pay in fees is a dollar that's not working for you in the market. The investment industry has become much more transparent about costs than it used to be, but you still need to actively seek out low-cost options. Index funds and exchange-traded funds are fantastic for beginners, precisely because they're cheap and they diversify your money across hundreds of companies. You don't need fancy managed funds with celebrity fund managers. You need simplicity and low costs. Those two things are the foundation of building real wealth in the stock market. Now that you understand these 5 mistakes, let me give you the framework for doing this right. First, educate yourself. Read books, read annual reports, understand what you're buying. Know your timeline, know your goals, and know your risk tolerance. Write it down, make it real. Third, invest regularly. Most successful investors don't try to time the market. They invest automatically, every single month. They take advantage of dollar cost averaging, which smooths out the ups and downs of the market over time. Fourth, keep your costs low. Choose index funds, ETFs, or low-cost mutual funds. Avoid high-fee managed funds unless you have a very specific reason to use them. Fifth, monitor your portfolio, but don't obsess over it. Check in once a quarter or once a year. Rebalance if you need to. But don't check your stock prices every single day. That's when emotions kick in, and that's when you make mistakes. Sixth, think long-term. The stock market is not a way to get rich quick. It's a way to build sustainable wealth over decades. If you're looking for quick gains, you're in the wrong place. If you're building a financial foundation for your future, you're in exactly the right place. The beautiful thing about the stock market is that it rewards patience and punishes panic. If you can stay calm, stick to your plan, and avoid these 5 mistakes, you have a statistically excellent chance of building real wealth. You don't need to be a genius. You don't need special knowledge. You don't need to time the market perfectly. You just need to be consistent, thoughtful, and disciplined. Please like this video if you found this valuable, because it really does help us reach more people who need to hear this message. One more thing before we wrap up. The worst time to start investing was 20 years ago. The second worst time is today. Every single day you wait is a day you're not taking advantage of compound growth. You don't need to have all the money figured out perfectly. You just need to start. Open a brokerage account, educate yourself a little bit, put in whatever you can afford, even if it's a small amount. Then, set it up so that money automatically invests every month and you let it grow. That's the path to wealth. That's how normal people build real financial security. If this video helped you understand the stock market a little better, I'd really appreciate it if you'd subscribe to the channel. We post videos like this regularly, helping you make smarter financial decisions and avoid costly mistakes. What's one of these 5 mistakes that you think you're most likely to make? Leave a comment down below and let me know. I read every single comment, and I'd love to hear about your investing journey. Thanks so much for watching, and I'll see you in the next video.